Welcome back to the channel, everyone. Today I want to talk about how Gary Gensler and the SEC are finally starting to make some change and are bringing in the everything crackdown. And I've also got some words of encouragement for my fellow apes, so stay tuned and let's make some money. But before I dive into the video, if you haven't already, be sure to sign up to Moomoo using the special Thomas James Investing promotion. Not only do you get a free stock worth up to $350, and not only do you get a second free stock with a guaranteed value of $50 on top of that, but you also get a third entirely free stock with another guaranteed value of $30. So that's at least $80 in guaranteed free stocks just for signing up with Moomoo and depositing at least $100. You could always sell those free stocks and get 2 entirely free shares of AMC just for signing up. Linked in the description below. And for anyone wondering, you get this free stock when you open your account and deposit the $100. You get the Thomas James Investing stock on the 12th of October, and you get this final stock after your account has been open for 30 days. And now I want to dive straight in with the key information. So, SEC chief to Wall Street, the everything crackdown is coming. From crypto to meme stocks, Gensler pledges to tackle it all. A full agenda has allies. Critics questioning, can he do it? Now, obviously at the moment, the joke in Washington and amongst retail investors is that Gary Gensler could inspire his own version of the game, drink every time. The rules of that game, down a shot every time the US SEC chief says he's asked the staff to consider new regulations. Gensler has asked the staff about oversight for crypto, drink, for online brokers, drink again, and for green investment funds, drink yet again. During 2 recent congressional hearings, Gensler used the phrase no fewer than 30 times, enough, one lobbyist quipped, to induce alcohol poisoning. Obviously what the start of this article is getting at is that Gary Gensler has so far made lots and lots of promises, but hasn't yet really shown any action towards all of those promises. But for Wall Street, Gensler's plans are hardly something to laugh about. He's laying out one of the most ambitious agendas in the SEC's 87-year history. Some 49 proposals have already been made, many already drawing opposition from hedge funds, stock exchanges, online brokers, and public companies. He's been similarly aggressive on agency enforcement cases, which can tank share prices, spur fines, and trigger embarrassing publicity. Gensler, an ex-Goldman executive whose earlier Washington experience includes a hard-fought battle against big banks to bring oversight to the vast derivatives market, says he's confident the SEC can move ahead of many issues all at once. In an interview, he added that he sometimes thinks of the famous Martin Luther King Jr. speech about the fierce urgency of now when it comes to the regulator's agenda. A few Democrats and outside advisors have urged Gensler to narrow his scope to more manageable load. The policies he's advocating, they argue, may take years to complete and have prompted powerful corporate interests to start discussing strategies for suing the SEC. For his part, Gensler insists that he has no priorities because everything is at the top of the list. Don't ask me about my 3 daughters and which one I spend more time with, he said. And actually there's plenty of action inside the agency. Gensler has already set up some 50 teams involving about 200 people to write rule proposals. Each has staff from the General Counsel's office as well as economists to carefully weigh the costs and benefits, a key requirement of federal law. And one area vexing Wall Street is Gensler's pledge to overhaul the equity market's plumbing in response to this year's meme stock mania. The wild trading has prompted several congressional hearings and put firms including Robinhood and Citadel on edge because new regulations could hurt their lucrative business. Executives, as in Wall Street executives, like executives from Citadel, who've met with SEC officials have been privately cautioned that the market structure rules being developed may be extreme. The warning from inside the agency shouldn't come as a surprise. Interviews with more than 24 people who have served in the government with Gensler or clashed with him when he ran the Commodity Futures Trading Commission during the Obama administration say he won't pare back his ambitions or shy away from a fight. Many of those willing to discuss Gensler candidly requested anonymity. Some said they admire him, while others had a hard time mentioning his name without adding an epithet. But all said they would never bet against him. They painted a picture of a relentless and skilled manipulator of the bureaucracy who cares little about making enemies or exhausting staff members. If anyone underestimates his ability to get things done, they do so at their own peril, said Micah Green, a lobbyist at law firm Steptoe & Johnson. So here we've got a breakdown of the top 10 things that Gary Gensler is investigating: gamification of the markets, SPACs, climate change disclosures, investment advisor ESG rules, Wall Street pay, security-based swap holdings, short sale disclosures, market structure modernization, delisting of Chinese stocks, and human capital. I guess the main three are security-based swap holdings, short sale disclosures, and market structure modernization, with rule implementation timelines as early as next month, all the way to April of next year. Still, much of Gensler's agenda is daunting. Finding a solution to the social media driven surges of GameStop and AMC and other meme stocks, for example, entails confronting several complicated issues. Tampering with any one of them could have unintended consequences for millions of investors. And now, interestingly, it seems as if Ken Griffin has been caught lying yet again. Check this out. Ken Griffin said he would be quite fine if payment for order flow was banned, and also said, "I'm okay with that." The Financial Times article says Kenneth Griffin, the founder of Citadel Securities, said he'd be quite fine if payment for order flow was banned, as the controversial practice comes under increasing scrutiny from securities regulators. Kenny Boy said payment for order flow is a cost to me, so if you're going to tell me that by regulatory fiat, one of my major items of expense disappears, I'm okay with that. But per Bloomberg, Citadel is already vigorously opposing such a move. Turns out, Ken Griffin is not quite fine with payment for order flow getting banned. And now per the Bloomberg article, it says eliminating the payments would cut right through the business models of electronic trading firms that control much of US stock trading, including Citadel Securities and Virtue Financial. They are already vigorously opposing such a move, as are Robinhood, Charles Schwab and other brokers. And therefore you have it direct that Citadel and Virtue are already opposing the ban of payment for order flow. So clearly when Ken Griffin said he's absolutely okay with payment for order flow being taken away, he lied yet again. And now I also wanted to offer you all some words of encouragement. The market will test you, AMC and GameStop repeatedly until all options are exhausted. No help is coming, but you don't require it. You did your due diligence, invested, and have already reaped the reward. You've witnessed blatant market manipulation and collusion. Seeing is believing, so await capitulation. We know at the moment the hedgies are trying to do everything they can to run the volume dry. They're doing everything they can to try and quash the social sentiment of AMC and GameStop. This is Google Trends searched for AMC and GameStop, which basically shows the number of searches in Google over time. Obviously, in January, AMC and GameStop were getting a lot of attention. And again, back in June, AMC was getting most of the attention, but GameStop still had some as well. Now we can see in January that interest for AMC and GameStop spiked and then slowly reduced down to an absolute bottom around early to mid-May. Obviously, interest then shot up again around June, and it's been slowly reducing and now is pretty much at an all-time low of sentiment since we last saw it back here in May. Back here in May, AMC had a sentiment rating of only 5. At the moment, AMC still has a sentiment rating of 7, so maybe the hedgies are trying to quash even more sentiment as much as they possibly can before letting AMC run up again. Obviously, I spoke in my video yesterday about how the hedgies are trying to secure a net long position before running up the AMC stock again, so they can actually profit from the next run up themselves. And this user reckons that if AMC gets another gamma squeeze, it will be the last, as in this gamma squeeze will turn into the short squeeze, and it will be the mother of all short squeezes. Ever since August, I've done deep research into the cycle theory and the algorithm. Many apes, however, are under the impression that the cycle will continue to repeat after the next run up, and the run after that, and the run after that. As in the premise of a big move up, then around a 50% reduction, and then sideways action for a few more months, rinse and repeat. I myself erroneously thought AMC could also go back down after the next gamma squeeze, and then repeat the cycle once more for a 4th or a 5th cycle. But it won't. When AMC has another gamma squeeze, like January or June, the short squeeze will start, and AMC will begin its flight launch to the moon. Let me explain why. So firstly, let's start with GameStop. what happened to GameStop in late January when it ran up to $500, only to see trading halted and crash back down to $90. It was about to erode the shorts until short hedge funds hit the kill switch and brokers like Robinhood PCO'd or position closed only GameStop and AMC and other meme stocks. Here's the founder and chairman of Interactive Brokers on what happened on January 27th. Now, I've obviously played you this video before, but he basically says that we were this close to breaking the system and everybody having to cover, all of the shorts having to cover. They were so close to the breaking point, which explains why Robinhood was willing to risk everything to shut down any more buy orders for GameStop. Short hedge funds like Citadel also knew about PCOing ahead of time, which is why they shorted GameStop on the way from that $500 level to regain some of those losses and continue to remain solvent for the time being. Passing that $500 level for GameStop would have been the breaking point for short hedge funds and start the squeeze. Many apes would say $480, but I'm saying the $500 level as a fairly conservative range that I'm confident enough that it would have initiated the short squeeze. And he's also confident that this $500 level will still initiate the short squeeze, and that's because short hedge funds still own short positions around that $500 range from when they got shut down back in January and shorted GameStop on the way down. They've been using those unrealized gains from the $500 short downwards to pass their margin requirements. If the price were to rebound and break that level of resistance, the shorts would not only be under heavy losses, but the unrealized gains from their massive short positions from $500 down would turn into unrealized losses and would kill their margin and actually be a catalyst for the short squeeze. GameStop's market cap right now is around $13.21 billion for a $172 share price. For GameStop to break through that $500 level and initiate the short squeeze, it would make the market cap around $40 billion. Since GameStop and AMC tend to move in tandem and are both in the basket of stocks being heavily shorted all the same, it's reasonable to say if AMC also surpassed the $40 billion market cap, that would very well be the squeeze trigger for short hedge funds as well. AMC's market cap right now is $19 billion for a price of $37 per share. For AMC to achieve a $40 billion market cap, it'd need to break through $80 per share. And that's interesting and curious because AMC was very, very close to breaking through that level back in June. But short hedge funds threw everything they had to keep AMC underneath of that threshold, such as having Mudrick Capital immediately buy millions of AMC shares over the counter, only to dump it all right after and try to artificially create a sell-off, among other nefarious short hedge fund tactics. But AMC running up around 500% back in June and GameStop only running up around 50% in that time explains this theory well. Short hedge funds must have needed to let them run up a little bit back then because they couldn't afford to keep the price so low. However, they definitely couldn't afford for GameStop to run up another 500% because that would break the $500 level and initiate the short squeeze. So they chose to let AMC run up a bit instead. As the market cap was only around $6 billion at the time, they could afford that 500% run up without it breaking the $40 billion market cap. Now that it's over, GameStop and AMC won't have any more mini gamma squeezes or run-ups, and not without forcing the MOAS, because it would break that $500 or $80 level. Cyclically speaking, if the logarithmic scenario were to happen again, where AMC breaks all-time highs and follows the algorithmic pattern that the other gamma squeezes presented, AMC would fly through that $200 level easily. However, it would not return back down, just like the run up to $70, as it would have obviously broken that $40 billion market cap, and as it would be over $100 billion, and pretty much the covering would have started on both GameStop and AMC. And that's when the real games begin, and that's when you'll see the price move up by hundreds or thousands of dollars every day. Guys, be sure to let me know down in the comments below what you think about the SEC and Gary Gensler finally starting to take action, and whether you think the next gamma squeeze or run up will be the last, and whether it will activate the mother of all short squeezes. And while you're down there, also be sure to sign up to Moomoo using the special Thomas James Investing promotion, linked in the description below. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.